Hey guys, it is a pleasure to be here. And you tell me, people just voice in if you can't hear me, if there's any trouble hearing what I'm saying. And then also feel free that at any point in the conversation, put a question in the comments, and I will do my best to check it out. Feel free to interrupt me. I do really good off the cuff, and don't feel shy or feel like you need to wait until the Q&A. If you throw the questions into the comments, then I'll address them as they come in. So I'm a partner at VentureSouq. I'm one of the founding partners of VentureSouq, and we're a venture capital firm based here in Dubai. I like to say that our own trajectory as a firm sort of maps to the broader MENA ecosystem, the development of the MENA venture capital startup ecosystem in general. So we started in 2013. We were an angel syndicate, a group of friends that were getting together and giving small amounts of money to other friends that were trying to get projects up and going. And we positioning ourselves as the investors in this equation and other people as the founders. Our network of potential investors kind of grew, and then we institutionalized. We went through all sorts of different contortions to our business model, and we've arrived at where we are now. We are a fund manager. We manage a $50 million fund that's focused on FinTech in the MENA region. And for context of where the region is now on the venture capital side, we are the first real vertical venture fund. We're the first venture fund that's raised a real amount of money that's focused on a specific topic, and that topic is FinTech. We are a component to the capital provider, and VCs are a component to a bigger equation, which is the enterprise, and the goal is for enterprises to grow big. And I think a lot of you are thinking about starting businesses. You should be aware of the role that venture capital companies play in a business, and what makes them tick, what makes us tick. And so before I start, I will say that that we have a business model just like anybody else does. I think there's a common conception that the venture capital group just is pitched a company and then decides for him or herself whether they would like to invest. And so it's kind of like a referendum on whether they like me or whether they like the idea or whether the idea is even good enough. That's oftentimes not the case. Oftentimes venture capitalists are serving for their stakeholders. They have raised money from other people, and those other people have requirements, and they are oftentimes trying to fulfill those constraints that their investors have given them, that their investors have put onto them. And so what I'm showing you today is a macro report, is kind of like a macro overview about what's going on in FinTech as a FinTech fund manager in MENA that I would potentially present to our investors. So this is like almost like a content pitch to our potential investors to say, here's why you should be investing into FinTech. And I think as a founder, it's really important to know the script that the VC has for his stakeholders or her stakeholders, and you'll be able to relate to them and position yourself a lot better to them. So if we don't mind pulling up the screen, I can get started. Okay, cool. So great title. What's up with FinTech? I think that FinTech has popped off. I can say that 18 months ago when we started raising money, the pushback was, is there a big enough pipeline of deals to make a venture capital fund work? It's much like a university. Venture capital firms run on a funnel, and you're looking at a large number of companies, you're funneling that down, and then you're ultimately deciding to invest into a very small number of companies. And so the bigger the top of the funnel, then what's viewed to be the stronger the prospects of the fund. And when we first started raising our FinTech fund, it was, well, there's just not enough companies at the top of the funnel. There's not enough people that are starting FinTech businesses. And that has totally changed over the course of 18 months. And it's been probably 6 months since we got the question of, hey, the logic of a FinTech fund. I think we timed it perfectly well, right as the market was sort of popping off, is right when we came in. So FinTech, if you look at kind of like the numbers, 2018 globally is when FinTech really crossed this threshold of being 50% of all venture investments. That was driven by a couple of mega rounds. Ant Financial is the kind of like financial services ARM that shot off of Alibaba. Stripe is now a $100 billion company. These guys raised mega rounds, and FinTech hit 50% of all venture funding in 2018 globally. 2019 and 2020 were flat. 2019, there was a tapering, a kind of natural cyclical tapering in the amount of capital going into FinTech. And then 2020, of course, was COVID. And then 2021 was an explosion. So you hit this threshold, 2018. There's a little bit of stagnation or flatlining to where people think, okay, are we, have we sort of like hit the level that FinTech is going to hit? And then last year it just shot through the roof. If you don't mind going to the next, slide. And in our backyard, MENA, exactly the same thing happened. So you look at where we were in 2018, 50 million some odd dollars of funding into FinTech. That's on total like regional investing of, let's say, $350 to $400 million. And this year, last year, 2021, we hit almost $450 million. So from 50 to $450 million. It says over 500% growth. It's like closer to 900% growth over a 4-year period. And much of that money was coming in from international VCs. We're going to talk about that a little bit. So if you can go to the next slide. What gives? Next. 4 things. All right. This is what I think has characterized FinTech over the last 18 months. Number 1 is you have big, loud success stories in venture, in general, not just in FinTech, but just in like the familiarity or the association of venture capital investing with big mega outcomes has become clear, has like manifested itself in the last couple of years. Number 2, inward infusion of equity capital. Number 3, the regulators are really leaning into FinTech as a service that's needed in the region. And then number 4, the emergence of capital debt. So next slide, please. The success stories. You guys, for those of you who are in MENA, and really anywhere in MENA, you will recognize the 2 names there. Careem is the leading ride-hailing business. Souq is the leading e-commerce business. And actually, if you look at other regions around the world, those are 2 very basic. Those are kind of like, startup ecosystem, 1.0 are like the ride-hailing guy in the generation that we're talking about now. Let's say 2015 until today, it's ride-hailing and e-commerce are kind of like the basics. And we had big, loud success stories in both of those being acquired by international operators. And then I would say at that point in time, that was like 2017, 2018. And then there was a okay, all right, is this kind of like a one-act pony? There were circumstances that led to those acquisitions. For example, Careem's acquisition was largely viewed to be driven by Uber's impending IPO, and the IPO would have, the threshold of size that would get people compensated inside the company. The IPO needed to be a certain size. Okay, so we just need to buy revenue from wherever we can get it. So is that real, or is that just a circumstantial exit? And then what we saw over the last 2 years is that no, it wasn't circumstantial. There are more and more sort of outcomes coming. Joaker last year, InstaShop also last year. Katopi wasn't an exit, but it was a $400 million plus infusion of equity led by SoftBank. And then all of BNPL, buy now, pay later. Globally, you recognize names like Klarna or Afterpay. That whole space really popped off at like almost like one point in time. There was a 6-month period where you had multiple BNPLs that were all raising capital from people like us and going to merchants and trying to sign them up. And it was a free-for-all. And you saw big outcomes. International players came in and tried to claim their territory. One called Tamara was acquired essentially by Checkout.com. Another called Spotty was acquired by an Australian group called Zip. And then Tabby has sort of stayed the course and and has raised now probably close to $200 million. And we're an investor in Tabby. So we as investors, we're looking for these type of mega outcomes, and that is going to encourage more investment capital to come into the region. And then you can't ignore these like big global success stories that are on a next level quantum. I said Stripe is $100 billion plus. Checkout now is close to $50 billion, maybe even more than $50 billion. Brex and SoFi are both mega success stories. So people see these, and that has an effect into catalyzing fintech in the region. Number two, inward infusion of equity capital. So we are sitting in a very capital-rich region, the GCC, and what has historically happened is that a lot of the investment has been directed outside, particularly in venture. All of the big sort of venture names that you may or may not recognize, depending on how sort of plugged in you are, but Andreessen Horowitz and Sequoia and Benchmark and Kleiner Perkins, the sort of storied names in venture capital, they've been backed by GCC money forever. There's been a lot of capital that's been invested from this region into venture capital. It's just that very little of it was invested into this region. And in 2018, 2019, there was kind of like this domino effect that actually it was Bahrain, I think, that was sort of the first one who sort of put their hands up and said, we're going to set aside a pool of capital, and that's going to be given to regional venture fund managers. And the thesis that we're looking to back are people that want to invest into MENA-based companies. And then you see, Saudi comes and the UAE comes, and these big mega pools that are being given to managers specifically, and like I said, to invest into this region. So there's a mandate, there's a pitch, there's a thesis that we went out and convinced them to give us money against, and we have to invest into that thesis. And all of that money, capital plus labor equals enterprise. It gives a huge amount of firepower to companies to go out and grow, and that's had a huge catalyzing effect. And right now it's kind of like, oh, valuations are through the roof. Well, it's not just a market cap thing that is extreme in the effect. There's also a market share thing. Market share is growing almost at the same level that market cap is growing. It hasn't really been decoupled, and so that is a way to think about valuation. If you go to the next slide, what regulators have done, setting up, this is a notoriously difficult region to operate from a regulatory standpoint, and essentially all regulators across the region in financial services, you have ministries of finance, you have central banks, you have different groups that are sort of acting as regulatory overseers, and most of them have issued frameworks that allow for individuals to mobilize, to pilot in a contained way their products, and then to iterate, to perfect those products, make sure they're safe, and make sure they're robust, make sure they can scale and handle things that go wrong. And that has had a positive effect towards encouraging people to set up businesses. So you have a huge amount of capital, you've got big success stories, you got a big amount of capital that's being pushed into the region. You got regulators that are saying, yeah, okay, you can do this, no problem, come and set up, and whatever you want to do, you can test it. And then number four, if you could skip to the next slide. Number four is maybe something that a lot of people haven't looked at, but it's a big one. Also on the capital side, venture is characterized by equity capital, right? And there's a huge other pool of money that for a long time or until a certain level of maturity is hit is kind of like off. It's like not available to early stage companies, and that's debt. Debt. People who lend typically want things like credit worthiness. Well, guess what? The most startup companies aren't really that credit worthy. They don't have a history of profitability. They don't have heavy asset bases that could be used to collateralize for debt. And so there's a huge sort of potential pool of money that is kind of like not available for early stage companies. And when you're talking about fintech in particular, that's especially important because a lot of these companies, if you think about it, their product is actually credit. Many of the companies that we talk about, the problem that they're solving in the market is giving individuals or small businesses better access to credit. It is hard for certain segment of the population to borrow, and therefore without being able to access borrowing, then there's a lot of quality of life type of improvement that they're doing without. So certain individuals and certain small businesses have always had a hard time borrowing in this part of the world, and startups are stepping in to fill that gap. And therefore, in order for them to, if you think about it, if your product is credit, if what you're offering to businesses is, I'm going to give you access to loans that you otherwise wouldn't have, then you need, in order for the valuation of your company, in order for your top line revenue to grow, then you need to have more credit to give. And so the emergence of venture debt has been a big one for fintech in particular. So think about debt in two ways. One, it serves as an additional source of money for companies in addition to equity capital. So it gives you more firepower to go out and grow. And then on the other side, it actually is the product for a number of early stage companies. And so its availability has catalyzed those companies to grow and take market share. Next. So where do we invest as a venture capital firm? Like if you look at those four drivers, okay, what are we paying attention to? Next slide, please. This is my favorite slide of all time. This is a landing page for a bank, a traditional bank, Wells Fargo. And you may have seen something like this for Craigslist. Craigslist, it used to be a sort of classified for all sorts of products and services. And each of in the same way that this was done for Craigslist, you can do it for a bank. Each of the services that a bank would offer, and you can go to your own bank and you can see it's the same thing. If you want a mortgage, or you want a credit card, or you want to open an account, or you want to transfer money. So each of these little services that a bank does is being attacked by another startup that says, I can do it better, I can do it cheaper, I can do it in a way that's more convenient for the user, and in a way that better integrates with whatever the user needs it to integrate with. And each little segment that a bank used to own is now being perfected by another $1 billion fintech startup. And so basically going into dissecting a bank and understanding where there can be an incremental improvement on the suite of services on a service by service basis is something that we spend a lot of time thinking about. That usually the incumbent, when we talk about fintech, is a bank or a large insurance company. But financial services has historically developed in a way where you have large players that command significant market share, and so that is where the displacement is going to happen. And as investors, we pay close attention to how what companies are doing relates to what banks do. And the next slide is kind of a better illustration of that. You can forget about the front end service. You can also chop a bank into its back end, and you can see what of the sort of like almost like value chain inside the bank. There are different components that are being tackled and improved upon by startups. And what we're starting to see is certain banks are saying, you know what, all right, if there's going to be a perpetual sort of death by 1,000 cuts from all these little startups that are coming and trying to take this business or that business or this business or that business, let us reposition ourselves and lean into that. And let us we can sort of do this like license as a service. You can let all of these companies come and use our platform to push their own service. They can go out and they can do the customer acquisition, and they can just use our license, or they can use our brand, and we can basically dramatically reduce the cost basis of a bank by partnering with any number of fintechs. And so we're starting to see that type of thing happen. Next slide. We are in this region in MENA. We see like mega money being spent in very broad digital bank projects. You see big pools of money that are going in, and then you see a somewhat mature infrastructure layer in many markets, not all markets, but you're starting to see that basic payment gateways, for example, are well serviced in most markets, and so we focus. And then the next slide. So Web3 is something that we're also paying very close attention to, and the way I like to characterize what in my mind is that you had from 2000 to 2015, what characterized venture capital in general was the dramatic reduction in friction. If you see the vertical axis, the dramatic reduction in friction in accessing and distributing information. So BBC, CNN, Arabia, these used to be the conduits of information. Information would flow in, and then they would package, and then they would distribute it out to users. And that's high friction, that's high centralization. And what we saw, those who bet on platforms that were unwinding that were decentralizing the way that information is generated or accessed, those are the big winners. Anybody who bet on Google, YouTube, on Facebook early are the ones who won from 2000 to 2015. What's now into the future, for the next 10 years, there's an argument that the winners are going to be the groups that are applying a similar type of transition in financial services in the way that value is stored or transferred. And so that's something that we pay very close attention to as well. And then last point, before we sort of before I shut up. By the way, Sharad, thanks for your question, and I hope that addresses where we are. We can talk specifically about Meta and NFT if there's time. But what's our goal as venture capital firms? There is a strong tendency in this region and anywhere in the world for pockets of money to big pools of money almost always have agendas. Anywhere in the world, if there's a big pool of money, there's some prerogative, there's some agenda that pool of money wants. And we as venture capital firms are really, our agenda is optimizing returns. Our support that we give to founders is a way for us to optimize the relationship that we have with those founders. So we work our butts off to help companies so that we have very strong relationship with those companies, so that when the time comes, we can increase our ownership of those companies, so that when those companies succeed, we make a lot of capital gains and give money back to our investors. Almost all venture capital firms have a prerogative to optimize their financial returns. And in this region, a lot of the agendas around the money has to do with the promotion of ecosystems at a country level. And on that is very important, and it's a very, very good thing. But that's our job, is actually to try to sit above that and to access capital where we can, but apply it to a pan-regional and even MENA plus type of footprint. If any one company operating in any one country in this region, we're 350 to 400 million people that live in Arabic-speaking countries, but it's divided into 20 companies, really of insignificant size to get to the scale that you need to get to win. But if it's one region, if a company can have access to the whole region, then it becomes interesting. Then you can have a Kareem type of outcome. And if you include Pakistan with 225 million people, and then if you include Bangladesh, basically our goal is we want to help companies. We want to find and then help companies that are able to unify a big market, because when you have access to a big market, you can have a big outcome. And when we have big outcomes, then we optimize the returns that we generate. So that's what we're trying to do. We sit in a world, we sit in a region where there's strong tendencies, there's strong sort of nationalistic tendencies, and we've got to try to distance ourselves from those and say, no, we're trying to look for commercial plays that are going to exist across the entire region. So I'll leave it with that. So that's the way that a venture, long story short, this is a lens into the way that a venture capital guy thinks, and then with the context of FinTech, because that's what we're super stoked about now. Any questions that anyone has, or
Hi, Tammer. That was really fantastic.
Okay.
Thank you. That was a fabulous FinTech primer.
Flattery goes a long way with me.
I know. So actually, we have some really interesting questions that have been sent in from the audience, but we only have a couple of minutes to get through. So the first one is, what FinTech startup, Tammer, to put you on the spot, would you start today? Yeah.
I would start a like back-end services for other FinTechs that want to lean into Web3. I know it sounds a little bit vague, but basically you have a sort of fundamental shift from a technology standpoint into this movement towards decentralization, and at the same time you've got this huge boon in financial services and FinTech startups and MENA, and at some point the FinTech startup ecosystem is going to have to adopt Web3. And so anybody who's coming with sort of tools that will enable that could do very well. And like, you've seen open banking. This is a concept that is like really attractive now. There's card issuance as a service is something that is doing very well. But those things are all still living in a centralized sort of like paradigm. There is a new paradigm that is decentralized, and that FinTechs that exist now that are doing.
I think we are having some internet connectivity issues. Tammer, are you still with us? I think we've lost him, but I'm glad we lost him at the end of his talk, not halfway through the beginning. We'll just give him 1 second to see if we can get him back. I feel like we're not able to. So in any case, because we were in the Q&A portion, I can suggest that you guys all send in your questions for Tammer. Leave them in the chat, or potentially even message him directly, and we'll try and see how we can get those answers resolved. We have him back. Do we have time? Yeah, for one more question?
Sorry about that.
Welcome back. One more question. Can we have one?
Yeah, of course.
What is your advice, Tammer, as someone who's seen so many founders in different parts of their journey, for people who are thinking about starting FinTech companies today, in our region specifically?
You do it in a way that do not allow you. So do it in partnership that allows you to sort of sidestep the direct regulatory approval process. Meaning, start as a service that maybe layers onto another company that is licensed and has obtained licenses in the areas where you want to operate, and come in as sort of an incremental improvement to that service, and then eventually go and do it on your own. Meaning, don't let the regulatory process slow down the sort of like process of getting your product to the market and getting people to adopt and sort of like get hooked on your product. Ultimately, if you deliver a superior product, there's this thing that's happening in the region in general, which is like there's a convergence of consumer expectations. Everybody wants something that is good. If your internet goes down in the middle of a presentation that you're giving to a Microsoft community, everyone is equally frustrated with that. And so the expectations that I have that my basic digital services are going to work are very high, but so is the guy who sits in Morocco or Sudan or in Saudi or in Turkey. So if you are building a product that is superior, then people are going to appreciate that, and figure out a way that allows you to get the product into the hands of the people without getting slowed down by the really arduous regulatory approval process that exists in the region. Figure out a way, and so literally speaking, in like a fintech context, you want to roll out a service, find a bank who is thinking the way that I said. Hey, you can lend out our license for the low cost of 15% of everything that you guys do. Cool, do that first. If you grow, if the product is beloved and you get to the point where, hey, I can cut out this part of my cost basis by applying for my own regulatory license in a market by market basis, then that's great. But don't start with that. Don't worry about that early. Worry about that after the product already is in the hands of users and users are satisfied.
Tammer, building on that question, what is your advice for fintech startups that are now scaling into different regulatory environments, right? Scaling your product and your solution is one thing. Scaling your regulation, I think, is a completely different question. How do you advise founders to think about that?
I think that there is always something that in this region, I think that many regulators are trying to. There's a pretty explicit agenda that every country wants startup growth. Like that's like I should have started out with that, guys. You're sitting in an environment. We're not oil and gas people here. We're not largely not real estate developers. The guys at the top want this to happen. They want growth in this arena. It will create jobs. It will create multi-generational wealth that will carry beyond the carbon-based economy that exists now. And so generally there is a desire to make things work.
Yeah.
And so if you want to scale into a new market, then you go to the regulator directly and it's a value prop. This is what I'm going to give to you. If you're a company that's got hundreds of employees, I'm going to open up an office and I'm going to hire a bunch of people here. Or if you're a service that can layer onto some other government service, I can improve that in this way. If your product is if you're scaling across the region, that means your product is good. I mean, it should. Like, you shouldn't be raising capital scaling across the region for a product that isn't good. And if your product is good and people like you, then you have a certain degree of leverage to go to the regulator and say, look, I want to come in and here's what we want to do. And the regulator in most cases is going to say, okay, let's work out what the best formula is here. They're very, like, a unique thing in the region is that the regulator is very, very willing to just have like direct conversations with companies and work with them. It's not some matrix and check the box and check this and then you shall be granted the license that you want. It's more commercial almost. And so, and that's why I say, if you go and try to play the regulatory game first, and it's more like a commercial negotiation, well, then you're weak, when you're just starting a business. You don't have leverage.
Thank you.
Commercially, Yeah.
Tammer, thank you so much. Incredible insights, incredible primer on fintech. I'm glad we got you back. Those were some really great questions. Thank you, fabulous audience. Thank you, Tammer. Absolute pleasure to you.
Thank you, guys.